Right, this part is on notes receivable, where revenue recognition goes to party. So, this is one of Carl's customers, Mr. Moneylater, and he comes into Carl's business and wants to buy 8 paddles for a total of $400. But he says, I can't pay for these now. I want to give you the money later. Get it? Yeah, no, it's a bad joke. Alright, so Carl often gives customers 30 days to pay. We record accounts receivable, as we've seen in previous videos. But Mr. Moneylater wants 6 months to pay. Carl might accept this, but he's likely going to charge interest to Mr. Moneylater. So Carl agrees to let Mr. Moneylater purchase 8 paddles for $400 on August 1st. Mr. Moneylater must pay the $400 in 6 months, along with 6% interest. Interest is going to be paid at the end of the 6-month period. So, on his books, Carl would make a journal entry, August 1st, 2027, that looks something like this. He would record the note receivable, $400, the sales revenue of $400, and then he would record the cost of goods sold and the inventory, whatever they might be. I made up some numbers here. I put in $264. So, going forward, what has to happen with this note receivable? It's a little bit different than simple accounts receivable. So here's our 6-month timeline. We have the months of August, September, October, November, December, and January. Carl is going to receive from Mr. Moneylater the purchase amount, which is $400, and some amount of interest on January 31st of 2028. Interest has a specific formula. So the formula that we use for interest is I, which represents interest, equals P times R times T, or what I like to call the I-party formula. I know, this video is full of bad jokes. Alright, so the I-party formula, hopefully maybe that's a way you can remember it. The I-party formula, P stands for principal, which is the original amount that's owed. R stands for the interest rate, which is usually an annual percentage. And then T is time, the fraction of the year, if it's an annual rate, which in most cases it is. So in our situation here, interest would equal the $400, the original amount, the principal, times 6%, times 6 divided by 12. 6 months out of 12 months. And we do it out of 12 months, again, because the interest rate, 6%, is an annual percentage rate. And so doing the calculation tells us here that interest for this 6-month time period is $12. Now each month that would then be $2 because it's 6 months. Charging interest to our customers leads to interest revenue. So Carl is going to earn interest revenue by agreeing to this arrangement with Mr. Moneylater. Now, we all know the revenue recognition principle tells us that revenue needs to be recorded when it's earned. And so in this situation, when is revenue earned? When is this interest revenue earned? Well, it's actually earned over the entire time period. Because from August to January, Mr. Moneylater has our money, essentially. He owes us money, and we're charging him interest on what he owes us. And so we're going to earn it little by little as time passes. And so we're going to earn $2 of interest revenue each month. Now we could record this monthly. There would be nothing wrong with that. But there's really dates in here that are big dates. So for a lot of companies, September 30th is the third quarter ending date. So we would put together third quarter financial statements as of September 30th. And obviously, with those companies that are calendar year, 12/31 is going to be the fourth quarter financial statements and the annual statements. And so, if not every month, especially these dates, we would want to record the fact that we have earned revenue during those time periods. So we're going to make some adjustments, some adjusting entries to record this interest accrual. And these are what the two entries would look like. We would record on September 30th interest receivable. Mr. Moneylater owes us interest. He's not paying it yet. And interest revenue. We've earned the interest of $4. The months of August and September. On December 31st, we would record the amount of interest we have earned and the amount of interest Mr. Moneylater owes us for the months of October, November, and December. So we would have $6 additional interest receivable and interest revenue. Now in our financial statements, interest revenue is typically reported in the non-operating section of the income statement. Here. The note receivable could be current or long-term, depending on how long the note receivable is for. Since this note receivable is for 6 months, that is less than 1 year, it's going to be reported in the current asset section. Interest receivable is always going to be reported in the current asset section, because it's typically going to be due before a year goes by. So we have interest revenue from the note, we have the note, and we have the interest receivable from the note, all impacting our financial statements. Now, when January 31st comes, Mr. Moneylater has to write us a check. And he's going to send us a check for the original purchase amount plus all of the interest, which is $412. $400 of it is the original purchase amount, and the $12 is for the interest. Now, when we debit cash for that amount, we can credit the notes receivable for $400. We can get rid of the interest receivable that we had set up, showing how much he owed us up to that point. And then we can record the additional $2 of revenue for January's revenue in 2028. What this then does for our income statement is, in the December 31st, 2027 income statement, we're going to have the interest revenue of $10. We earn $10 of the revenue in 2027. In the January 2028 income statement, we're going to see the additional interest revenue of $2. Now, this all again goes back to to revenue recognition, because we have to record revenue when it's earned. $10 of the revenue was earned in 2027. $2 of the revenue was earned in 2028. So by recording these entries in this way, we abide by revenue recognition. On the balance sheet, December 31st, 2027, we saw the note of $400 and the interest receivable of $10. But once we get paid by Mr. Moneylater in January of 2028, the note is gone and the interest receivable is gone. It is turned into cash. And so you see the change there from the $400 and the $10, that was back in 2027, to $412 in 2028 because of the additional $2 in revenue. So, in summary, notes receivable. Companies can choose to accept notes from their customers. Notes receivable represent money owed to the company that will be repaid with interest. Interest the formula for calculating interest is I, interest, equals principal times rate times time. P times R times T. And so we can call this the I-party formula. I-party is a way to remember. Okay. Interest revenue. Interest revenue is recorded when earned according to the revenue recognition principle. In order to ensure adherence to the revenue recognition principle, accrual adjustments must be made for accrued interest on the notes. And remember,